Hello and welcome to C-Suite Secrets. I'm Heather Parsons, your host, a serial entrepreneur, fractional CFO, and a business value strategist. I've spent years juggling business and family life while helping entrepreneurs scale, optimize their cash flow, and build real financial success. On our show, we bring you real conversations with founders, executives, and operators about what actually moves the needle in their business. No fluff, no filler, just smart strategy, systems that work, and insights that you can put to use in your business right away. With that, let's dive right in. Today on C-Suite Secrets, we have John Bentley on the show. John, welcome.
It was actually the pet startup we were trying to raise, and there's somebody that said they would take down our whole round, which means they would be one investor on like the one round, which means we'd be selling, I think it was about 7 or 8% to one person. So that's not a great position to put yourself in. But the thing is that what he wanted to deliver was cakes, on-demand cakes. Like, what if you have a birthday party and someone drops a cake? Now, we were doing pet transportations. The first thing I thought was, what would it be like to have a cake in the car with dogs and fur flying around and everything and that kind of thing? But, it's those kind of things you run into. Another one to watch out for is someone that says if you put them on the cap table, as an advisor, they can bring money in. Any type of advising agreement or anybody helping you raise money, it has to be tightly performance-based. I have no problem paying someone 10% of a raise. If you can go raise $10 million for my startup, I'll give you up to $1 million, or I'll give you some of that cash plus equity after the money's in the bank, after it's been collected, after it's truly cleared. Well, one other thing we ran into, and this is something that I would have never anticipated. So everybody knows founders are out giving the best pitch and the best story for their startup, not doing fraud. But when you're early on, you're heavy on the visionary. So you always want to keep that in check. But when you're talking to somebody that says they have a fund that's going to invest, you need to ask them how much money's in that fund. I've had a couple of rounds disappear of investment we had locked down because they could not fill their fund like they said they were going to. Now, it wasn't fraud or anything. It was a macro event where, the collapse of FTX created some ripples in the finance that for startups created two different rounds that just killed the ability to get funds. And so any funds that said that, they didn't actually have money in the bank. So a VC that's launched 4 funds, if they're putting you in fund 5, that's money they don't have. So they have as much money as you have customers at that point. It's
All right.
it puts you in a bad day one day whenever the money doesn't show up.
Right. And I think that's super important to note, right? So you're trying to make decisions based on these people's commitment, but there's no money been wired yet, right? So
Yeah.
as you have these conversations, I know, I haven't raised money in my personal business. I'm a big fan of bootstrapping unless you actually need to raise capital. I think there's a time and a place for both. But on the real estate side of my business, raising money is super important. But the last thing you want is to get down to the wire and then all of a sudden the money doesn't show up. Because now you've got pissed off people all over the place. Whoever's selling the property is upset. Whoever's buying the property is upset. And now they're scrambling and probably giving away more equity or parts of their project than they need to, all because somebody else couldn't follow through with their commitment. And as the founder or the co-founder, that's still on you. And your project is going to be delayed if some of this stuff happens. Another thing you mentioned, I think that I'd really like to dive in on is how long these people are on your cap table. I think from my perspective as a fractional CFO, the smaller your cap table, the better off you are, right? You want to retain some of that control. You don't want to have, 1,000 different people who have decision-making rights in your business. So the more that you can at least control the decision-making part of it, even if you do have to give away some equity, I think the better off that you are.
Yeah, there's a balance there. You don't want too many, but you don't want to give anybody too much of a stake either.
Right.
But one thing I wanted to say on the terms, I recently relocated and I was not planning to move. The reason why I relocated was because we had an investor that made an agreement to purchase some debt from us, and then strung it out, and then ultimately didn't come through. So one of the things, if you're out there listening to this and you're an investor, it's your money. You don't have to invest it. But every time you make it sound like you're going to, or you make a commitment and you don't follow through, you're impacting real people's lives. And it has a lot of repercussions. So you have to, and as an entrepreneur, you can only do so much. But on the cap table, the risk is really twofold. I mean, later investment, crowdfunding and stuff like that, part of the problem with it is it's created crowded cap tables, and there are people you have to keep up with. And anybody that's on the cap table could do a shareholder lawsuit. How successful it would be is questionable. How distracting and how much it would cost to defend doesn't really matter how much merit it has if they can get a lawyer and get it to go forward. You have to worry about that. You get a lot of advisors and things. It's a lot to maintain and things like that. So you do want to, but the cap table. I mean, the other thing is that if you're going to raise money the traditional way, you're going to have to sell the business, or you have to go public. You're going to have to exit. And when you're taking on investors, it's really best for you to exit or between Series A and Series B. So after you've seed is MVP, so you've launched your first product, you got it out there, you've tested it. Now with Series A, you've kind of upgraded the product to a real scalable product, and now you kind of got a growth engine. Either you keep taking investment because you can't bring in enough revenue to keep it growing at the pace that makes sense from a market standpoint, but generally you get acquired at that point. I mean, 10XDS, we're being acquired because we're at that point. And most companies don't go public. Facebook famously went public because it had to. It actually ran out of places it could hold private equity. So it actually outgrew the ability to stay private. It didn't go public because it really wanted to. It became a financial necessity. People that bring, now there are other forms of investment that are more debt-based, and some are more for social enterprises and things where there's more of a social element where you can do a debt instrument, but the debt instrument's based upon the health of the business. So it's not like a predatory note where they're going to just take over the company from it. It really is designed to see it grow, but and the investors are still making their money back. So there are some options like that. But that's just the downside is that if you want to grow, if you're building more of a technology-based business and you want it to grow and you want it to grow fast, it is really hard to cash flow it unless it's a really small niche product. But if you're really going for that, unicorn, which is $1 billion, or and really more that, even more realistically, $100 to $200 million kind of valuation, you end up needing the money. But the only way the people on the cap table get paid is if they exit, because it's largely illiquid and hard to sell type of equity.
That makes a lot of sense. And one other thing I want to throw in there as well, is we're not talking about a short amount of time here. So as you bring these people on and they're sitting on your cap table, you are responsible for their care and feeding for years. So to go from a seed round all the way through to between a Series A and a Series B can be anywhere between, what I've seen is 2 to 5 years, right? And it all depends. Technology is a little bit different.
Yeah, it's more like 5 to 10.
Yeah.
I mean, I've been with 10XDS. We're in the process of exiting, and it's a little more of it's not as straightforward an exit as anybody would want. So we've actually been exiting for over a year, and sometimes exits run like that. But I've been on calls every Friday with our investors, more as a participant. Our CEO leads them. He's been holding calls just about every Friday for 8 years.
Wow.
With investors, because we've got not every investor shows up. We've got some that are really engaged and have really helped the company. So it's a good way to kind of keep everybody on the same page and apprised and get some feedback and things. So it's been very beneficial for us. But, and as we're going through the exit, it's, it's 8, 9 years of phone calls of just going through it and going through the conversation and all that. And, as we're doing the acquisition, one of the things too is, how you compensate yourself as a founder gets interesting. So I've got founder shares, which are tax advantageous, but the way we're exiting doesn't really benefit me. And then the rest of my compensations and options, but the way we're exiting, they're not easy to exercise because it's not a cash, it's a trade for trade, equity swap. So making sure people are made whole and things like that can also be kind of challenging in those situations.
Yeah, absolutely. And I think the more you can think about some of this stuff up front, definitely the better off you're going to be at the end, right? Like if you go into business knowing that you need to make a successful exit between the 5 and 10 year mark, that whoever you bring in, you're in a relationship with them, good, bad, ugly, or indifferent, for that length of time. So I think it's really smart to be very intentional about who you bring into your business and how long you plan to stay for.
And when you start one, you should expect 10 years. We used to joke we thought we could exit in 5. So I'm now about 9 years into a 5-year exit.
Right, because you never know. That's just like whenever we do deals on the real estate side. 5 years is the minimum. We let our investors know normally 3 years you can do a cash out refi or do some sort of deal there. But 5 years is usually the general rule of thumb. You're going to be in it. You're going what, good, bad, or ugly, right? You may need to say, hey, we need more cash. It may be that the deal's not going the way you thought, or the build, or the customers, or heaven forbid, we have something like COVID during that time that throws everybody's business on their head. So I think the more we're prepared, the better off we are.
Well, on the investor side for us, I mean, when you're going venture capital, it's 7 out of 10 are going to be written off as just losses. So you generally about 7. Number 8 is going to probably operate, maybe break even, and then 9 may give a little return, and then 10 is going to be the one that covers the losses for the 7. So it's a high risk game, but that also means every time you start one of these and you start soliciting investors and things, you've really got a 3 out of 10 chance of providing any return at all, and only a 1 out of 10 chance of really making it happen.
Wow. Yeah.
Which is why I'm a serial entrepreneur, because I keep trying.
Right. And one of the last questions I have, this has been a really awesome conversation, is when should a founder walk away from a product? Even if they've been pouring into it for a long time, at what point do you say, okay, that enough is enough?
And I've talked to CEOs before that I've been working with and told them they don't have to keep working out on my account because, I don't want them to feel beholden. Right. But it's, if you got a product in market and it's just not getting traction, it's so Spot On is a good example of this. Though it's interesting is that we're in the New York market and we've got some rides in New Jersey, and it's generating enough income to keep itself operating, but not to grow. Okay. So at this point, our CEO has decided to keep it running, and we've had so many. We had COVID, which just kind of changed strategy. But with Uber and Lyft going public and all the financial problems they had, because Uber was way overvalued and was losing money when it went public. So it's never been a viable business. So all of that has made investment quite difficult in what we're doing. But it's that kind of question I really can't answer for a CEO. I mean, I'm with founders and I stick with them. And so Spot On.pet, our CEO, if she reaches out to me, I answer the call because we're in it together. But there's something, and I've got an idea I'm working on that I know once I go and I actually become the CEO and become the core founder for it, I'm in it for 10 years. Yeah, I'm in it to make it work. I'm in it to pivot. And I don't know. I mean, if it's destroying your personal life, if it's destroying your family, by all means, walk away from it. No venture is worth that. But beyond that, if people are still supporting you, and and you feel like you talk to advisors and things, but because the other thing is 10xts, we had 2 Series A rounds kind of be pulled out from underneath us. And it was kind of from FTX, and we weren't related to FTX or anything going on, but it was ripples that went and hit the finance market. So we should have gone out of business, quite honestly. But our CEO found a way to hook us into an initiative that we could deliver the value, and now we're getting a return for our investors. And I tell you, all of the founding team that's worked on the product has endured quite a bit, trying to make sure we get a return for our investors, because those investors gave us money,
Right.
and they trusted us with it, and we don't give up and we don't quit on it. So I guess that's the other thing is if all your investors tell you to walk away, you probably should walk away. But if you still got people rowing in the boat with you, then, and it's not destroying your life personally, you keep rowing, unless you just can't. I don't know. It is weird. I mean, and I got this. I actually have it in this. I put it on LinkedIn, and I have it in this booklet I wrote, the Making the Leap from Idea to Market. And it's a little video of a children's book that I really love that's called What Do You Do with an Idea? And it really talks about the idea and what it's like to nurture it and have it be different and people not accept it. And it's, even though it's for children, it's really profound for adults. And I recommend the 5-minute view of it. But there's something about an entrepreneur and their idea that I don't know how to tell them to give up on it, because it is so core to who they are that, again, unless it's destructive, it's going to have to be their call.
I like that. And I really agree. I get asked a lot of times when working with businesses, like what's kind of some of those thresholds, right? On when should you continue to bleed money or have issues. And my husband and I were actually talking about this late last week about, business and when should you pivot and do some of these other things. And I couldn't agree more. Like for me personally, giving up on being an entrepreneur, I don't know that I could do it. I may have to pivot. I may do something different in my business or, change my idea around a little bit to make it a little bit more viable, but actually giving up and closing the door, I don't know how it works. I've seen a lot of small businesses really struggle with that because they are losing a lot of money, and then it becomes a really tough decision because they have to decide how far in the hole do they want to get. I truly believe that we have a financial responsibility, especially to our investors. And I coach ladies on this all the time in the real estate space. If you still have a car, you still have your primary residence, and you still have a kidney, you might want to figure out how you're going to pay that back, because it matters to the investor as well. Most folks are not out here rolling around with billions of dollars that they can just write off $1 million and never feel a sting from it.
Well, I have closed a business before because it just didn't make sense to continue it on, and it was just actually what happened was we started a managed service provider in a rural area, so up in eastern Kentucky, hitting southeast Ohio and northwest West Virginia, and this thing happened called a year into it called the Great Recession, and it would have been good to know about it before we started,
right?
But what's interesting happened is that I had somebody that I knew that was in a similar business that decided to exit it and transitioned a bunch of clients to me. And then when I decided to close, he had taken on a role with another company, and so we kind of, it wasn't so much, it was almost like an acqui-hire. The customers went back to both of us, and I went to go work for that company for a while, serving the same customers. So, and then what's funny is the thing with this larger business that was trying this experiment, everybody that was trying it left, and I was the last one. So I ended up transitioning all my clients back to the guy that originally I transitioned a bunch from, and and he started serving them again. So I don't know if the business really ever ended. It just continued to shift what it looked like.
Right.
So
I think
I ended up leaving it, but come to think of it, the service and what was going on with customers, that continued on. And I had to take some solace in that.
yeah, that's great. I think as entrepreneurs, sometimes we just have to pivot, and we learn a lot of it is just a learning opportunity, because you don't start out as an entrepreneur having all the answers. We hope that we can hang out with some other cool entrepreneurs that can help us along the way, but the majority of us are still trying to figure it out.
Always. That's why I call it the product journey.
Yeah, it is a journey for sure. Well,
And
John,
their
this is
journey's the same. You just you get better equipped every time you go out, but you always encounter new things with the same things in new ways.
right. Exactly. I think you do it a little bit smarter the next time around. I know whenever we
Or at least you
started,
make different mistakes. That's what I go for.
right? That's the goal. Definitely don't want to do the same one over and over again for sure.
Yeah,
But
that gets old.
right. Well, this has been great. I have one final question for you before we wrap up. I'd love to know, as you were getting started as an entrepreneur, what's one thing that you wish you would have known that you know now?
Um, I wish I would have put a little money aside for just the household to buffer things a little better. I kind of became an entrepreneur out of a lack of better options at the time. And so, I didn't do that, but, you know, keep, I would never, I never encumber a house. I did liquidate my savings to throw into one business. A burn your ships moment, as one book wrote. I don't know if I would do that again, but keeping something for aside for you and your family just to kind of keep safe. I think that's really important. And 10xds, as that exit pays off, I'll actually be putting most of those assets in a trust that's controlled by my wife because I'm a serial entrepreneur. So, all funds look really good at some point for the wrong reason if I'm not careful.
Right. Well, we believe in our ideas and what we're working on. So I totally can
Yeah.
relate to what you're talking about. My husband and I talk about that all the time. What should the buffer be? How much? When is it okay to dip into it? Because I think you got to be really intentional about it. Because at the end of
Yeah.
the day, it's really easy to use it. Especially we're in the apartment space as well as having our accounting practice, and it's always something. Hey, a couple of weeks ago we needed to replace a bunch of steps, and we needed to do this and we needed to do that. And it's at what point do you say, okay, whoa, we're gonna have to wait a minute and make a different decision. So I love your perspective. I think it's really smart.
Yeah, you got to just be honest too about, is this to keep something that's working operating, or because we forget about this principle of sunk cost. Doesn't matter that I've got 5 million in it. Is the next 100,000 gonna make the difference of moving that 5 million forward, or am I just throwing another 100,000 in that money pit?
Right. And having a plan on how you're going to get out of that money pit is huge in that perspective. Because if you don't have a plan, a lot of times entrepreneurs are really just throwing good money after bad.
The real problem is that you dig deep enough, you hit bedrock, then you get a pickaxe and start chipping. It's like, no.
Right. It's whatever your time and tolerance is at that point. Um, well, this has been great, John. I really appreciate it. So if our listeners want to connect with you and learn more about what you're working on, what's the best way for them to reach out?
Well, I've become really active on LinkedIn. I'm John Bentley II on LinkedIn, or you can Google Code Wookie, which is my nickname on there. It actually will find me. I have a website, prdjrn.com. It's a little weird, but it stands for Product Journey. I wanted to keep it short. And I do offer a base camp review, which is a 1 hour intensive where we go through people's ideas. Uh, and figure out where you're at and where you're going. And then I do a write up with it called a route report using journey language to really give you concrete suggestions on what to do next. And I generally charge $500 for that. But right now, for anybody listening to the podcast, I have the code CSS 2025 that will reduce that down to $100.
Oh,
We
wow.
should have a link in the show notes. You also can download for free the Making the Leap from Idea to Market, which does take you from idea development all the way up to MVP.
That's great. Well, thank you so much. And we'll definitely make sure that that code and the links are in the show notes. Thank you for listening to part 2 of our conversation with John Bentley. And thank you for listening to C-Suite Secrets. If you have found today's conversation as valuable as I have, be sure to hit that like and follow button and share with another entrepreneur who's growing their business. If you want more tips on how to grow your business between episodes, be sure to check us out on Instagram at Heather Parsons Official. And until next time, keep growing. And remember, you don't have to do this alone.